Welcome to The Explainer. I am so thrilled you're here because today we are tackling one of the most explosive, mind-bending, and honestly, kind of tricky areas in modern finance. We're talking about quantum computing ETFs. Specifically, we're going to analyze the Wisdom Tree ETF approach and see exactly how it fits into a modern portfolio. Okay, let's dive right into this. $2 billion. That's the massive investment the White House just recently committed to accelerate quantum R&D. I mean, the stakes here are absolutely sky high. We're looking at a global technological race to actually leverage quantum mechanics, using qubits to calculate massive parallel probabilities all at once, basically solving problems exponentially faster than our absolute best supercomputers ever could. But, before we get too ahead of ourselves, we do need to ground our expectations just a bit. As industry experts are quick to point out, quantum computing is real, it's early, it's fragmented, and yeah, it's highly uncertain. While the potential to solve currently impossible problems in things like drug discovery, cryptography, and material science is absolutely huge, the space is still really speculative. And that uncertainty, well, that is exactly why having a targeted ETF strategy is absolutely crucial right now. You can't just throw darts here, you really need structure. So here's our roadmap for this explainer. We're going to hit the quantum investing boom, tackle defining a quantum company, unpack the wisdom tree approach, compare purity versus broad exposure, and finally look at building a modern portfolio. We're going to figure out how to avoid accidentally just buying a disguised big tech fund when you're actually looking for true future innovation. All right, jumping right into section 1, the quantum investing boom, and how the market is totally riding this wave. The numbers we're seeing lately are honestly staggering. Just take a look at the established Defiance QTUM ETF. Over the past 12 months, it delivered a massive 79.4% return. Seriously. And it also just crossed $5 billion in assets under management, hitting 3 consecutive AUM milestones in under 4 months. That is a tidal wave of investors piling in. But it begs a... And that brings us to section 2, defining a quantum company, and what I like to call the dilution problem. I want to ask you this directly. What exactly is a quantum company? I mean, it sounds like a simple question, right? But in this space, definitions are literally investment decisions. How an index defines a quantum company dictates exactly what you end up holding in your portfolio. And ultimately, that dictates what drives your returns. Think of it kind of like casting a giant wide net versus using a precision spear. On one hand, you have pure-play quantum companies like IonQ, right? Their entire business model relies on trapped ion quantum computers. But then, on the other hand, you have massive, diversified tech giants like Alphabet or Google. Broad, older ETFs tend to cast that really wide net, capturing these giant tech companies where, let's be honest, quantum revenue is practically a rounding error compared to their core businesses. And that completely dilutes your actual exposure. You might think you're buying the future of compute, but actually, you're basically just buying the NASDAQ 100 all over again. So let's move right into section 3, the wisdom tree approach. We're going to look at spearfishing for pure plays to solve this whole broad net problem. Now, what's really interesting here is this fundamentally different solution. Enter the Wisdom Tree Quantum Computing Fund, ticker WQTM. Launched in late 2025, it was co-developed with Classic, who, if you don't know, are a widely recognized leader in quantum software. They teamed up to build an index that specifically targets the quantum ecosystem with serious precision, directly taking on that big tech dilution trap we just talked about. Here's how WQTM actively categorizes the ecosystem. They explicitly divide companies into 2 distinct buckets. First, a pure play. That's a company whose primary overriding focus is quantum technology. Then you have a diversified innovator. That's a company exploring quantum, sure, but alongside a much broader, already existing business. Drawing a hard line between these two is absolutely the foundational step for getting targeted exposure. From there, they use this really clever, proprietary 2-step mechanic for the index. Step 1, they just start by equal weighting the eligible companies. Simple enough. But step 2 is where the magic happens. They actively tilt the portfolio. They push the weight toward companies with high relevancy and purity scores, and they pull weight away from the diversified companies that have lower relevancy. This intentionally scales way back on the big tech names and funnels your investment dollars directly toward the highly relevant pure plays, the ones actually building the core technology. Let's head into section 4, purity versus broad exposure, and see how QTM and WQTM actually stack up against each other. So the crucial point really reveals itself when we look at these two head-to-head. QTOM charges a 0.40% expense ratio and holds about 83 companies using a modified equal weight system. But look at WQTM. It charges a nearly identical 0.45%, but it only holds about 41 companies using that purity scoring system we just walked through. By focusing on roughly half the number of holdings, WQTM drastically cranks up its conviction and its purity. It's a much leaner, much more focused bet on the true quantum pioneers. And this brilliantly illustrates how that high conviction plays out in the real world, without completely ignoring risk. Look at the portfolio balance for WQTM. They intentionally maintain roughly 29.3% in pure players. So those are your highly volatile, massive upside names like IonQ, Rigetti, and D-Wave. But then they balance that out with 70.7% in diversified innovators, the folks providing the essential enabling infrastructure. So it's a very calculated, very risk-aware balance. What's also just super fascinating to me is how WQTM adapts to the actual science. Because right now, the qubit race is still wide open. We're talking trapped ions, superconducting qubits, neutral atoms, photonics. It's wild. And WQTM doesn't try to play fortune teller and predict a single winner. For example, in their May 2026 rebalance, they materially bumped up their allocation to Xanadu, which is a newly public photonic quantum pure player. They are literally letting the scientific progress, not arbitrary predictions, determine the winners across all these incredible modalities. All right, Section 5, building a modern portfolio. This is what I call the yes and pivot. Time to move from the theory to the practical stuff. So let's think back for a second to that massive 79% return that QTM had. Here's the thing. Broad ETFs like that overlap heavily with standard tech funds like QQQ. If you already hold broad market funds, there's a really good chance you already own QTM's biggest drivers, and you're probably paying a lower cost for them too. That massive one-year return, a lot of that was just the broader AI trade wearing a fancy quantum label. Adding a broad quantum ETF often just piles more large-cap tech on your already existing large-cap tech. So how do we actually build a smarter strategy here? Well, instead of making an or decision, think of it as a yes and approach. You can absolutely hold a core semiconductor ETF, like SMH, to capture today's massive AI hardware and classical computing boom. And as a satellite holding, you can add WQDM to gain targeted, non-overlapping exposure to tomorrow's quantum compute. It's the best of both worlds. You capture the present and the future without blindly doubling up on the exact same mega-cap stocks. Okay, to quickly summarize our actionable takeaways here. First, definitely treat quantum as a satellite, holding within your thematic allocation. Second, size your positions carefully, guys. This is a highly volatile sector because, let's face it, commercialization is largely a 2030s story. And third, really focus on pure play index methodologies. That ensures you're actually getting the targeted exposure you were paying for, rather than just broad tech dilution. We have covered some seriously incredible ground today, but I want to leave you with one final provocative thought. Are you ready to invest in the definition of tomorrow's technology? Because how you define a quantum company today is going to completely dictate your portfolio's success when this technology eventually reshapes our world. Take a hard look at your own allocations, double-check your overlap, and make sure your investments actually match your convictions. Thanks so much for joining me on The Explainer, and keep learning.